Welcome to the Ellsworth Advisors monthly update for November 2025. I'm Kelly Keenan, and this is Cameron Mealy. Happy holidays to everyone. Today we'll review what happened in November, what's been happening year to date, and a little bit of our thoughts going into the year end. Cam, why don't you kick us off with some economic data?
Thank you, Kelly. Good morning, everybody. Hope everyone's well out there. For reference, today is Thursday, December 4th. And Kelly, we were coming off of what was a 40-plus day government shutdown. Government has been reopened for about 3 weeks now. But that shutdown really left about a 6-week embargo on any sort of economic releases. So the information we have is a little bit dated, a little bit patched together, private sources, but give you our thoughts on the economy. Let's start with what we know. And what we know is what we've seen from GDP so far in 2025. As you'll remember, first quarter GDP came in at a 0.5% decline. Second quarter GDP, published on September 25th by the Bureau of Economic Analysis, they reported that according to their third estimate, second quarter GDP increased at an annualized rate of 3.8%. So from -5 to 3.8%, extremely strong growth. We're usually in the U.S. economy looking for about a 2% annualized return. So obviously 3.8% is kind of a blowout number. If we look towards the third quarter GDP, the Atlanta Fed in their GDP forecast model as of December 1st, they're projecting third quarter GDP will increase at an annualized rate of 3.9%. So another blowout quarter. Now, we won't get fourth quarter information until December 23rd, so we'll see how that comes in. But right now, looking at significant growth in the second and third quarter, that begs the question, why is everybody focused on a Fed rate cut? If the economy is so strong, why are we looking at a rate cut? Let's talk about a little bit of the history of that. On October 28th and 29th, the Fed held their last meeting. On the 29th, they announced a 25 basis point cut. That took the new target Fed funds rate to 3.75% to 4%. And it was a 10-2 vote by the Fed board governors to cut rates. After that cut, on October 29th, Jerome Powell came out and said, a cut in December is not a foregone conclusion. I repeat, not a foregone conclusion. What we've seen, though, over the last several weeks is it does seem like a December cut is a foregone conclusion. It does seem like a 25 basis point cut is in the offing. Anything can happen, but that certainly appears to be a high outcome, which would take the target rate to 3.5 to 3.75%. So if the economy is so strong, why is the Fed thinking about cutting interest rates, which is usually a boon to economic activity? Really, there's two things that we're looking at. It's the inflation is coming down, but we also have a softening labor market. Let's talk about the labor market. We're seeing layoffs, hiring freezes, slowing immigration, artificial intelligence, and robotics all seem to be taking a little bit of a toll on the labor market. On December 3rd, ADP, employment company ADP, published their national employment report, which showed a decline of 32,000 private sector jobs in November. Now, this is private sector, not private and public, but 32,000 private sector job loss in November would be the most significant drop since the summer of 2023. So we're now kind of at a 2.5-year low for employment. Unemployment rate is now at 4.4%, which historically is still low, but we're seeing an actual decline. So,
Well, yeah, let's talk about a couple of these things. And one, the employment numbers have, and we've talked about this the last several months, that employment's a little soft, but not necessarily falling off a cliff. We haven't had really good government official employment numbers for, a couple months now because of the shutdown. ADP numbers, they can tend to be a little bit volatile, but it does give us a little bit of gauge. And just this morning, the number ADP came out with actually was better than expected. So
that weekly jobless claim.
Yeah, so the softening, I would say, the kind of my read on it is it's still a little bit soft. The trend may have been broken a little bit. It's maybe a little better than expected. The reality, though, is when you get into the holidays, which obviously last week encompassed Thanksgiving, going the holidays, that kind of skews the numbers.
Seasonal employment.
We didn't see anything majorly bad,
Yep.
so that's good. But going to the holidays, the number's gonna be skewed. We really won't see probably a better picture on unemployment until January. So that's one of the fears the Fed, they don't wanna squash the economy, hurt employment. Well, we know employment's been a little soft, not horrible. And then the other side of the Fed decision is what's going on with inflation, which has been stubbornly in the high twos, around 3%, higher than the 2% the Fed wants. So it kind of puts the Fed, should we reduce rates or not?
They're really in a no-win
Things
situation.
are, pretty decent in the economy, um, at 3.75% for the short-term rate. Okay, that's no longer is that almost as high as the 2-year or the 10-year. So another reduction in interest rates brings the short term down closer to 3.5%. The Fed funds at 3.5, 10 years at 4, slightly over 4. Okay, that's a decent spread there. So, I could see them doing it one more time, then kind of holding off to get better numbers come January, see how GDP really comes out. The expectation GDP ever that I've been reading is, high threes, low fours. So, you know, economically things do not look that bad.
I mean, it feels to me like you cut 25 basis points, you're probably where we need to be for the intermediate term.
I think that's prudent.
Yeah.
It gives them by keeping them a little elevated, that gives them room to get aggressive in cutting if something drastic
Yeah.
were to happen to the economy, or if serious weakness started showing up. Versus you cut too low, then there's no place you can cut if the economy gets bad.
Yeah.
We're definitely not in a bad
Yeah.
economy.
If the economy stays where we're at, good news, bad news, employment solidifies a little bit. I really just don't think, I think rates are where they need to be. I don't see a lot of aggressive action by the Fed in 2026 unless they have to,
Correct.
which means the economy takes off or we've got some kind of major dislocation.
Yeah. And right now you have kind of two economies. You have higher income people, the more wealthy are doing great. It's kind of the lower end that's starting to get squeezed. We see that a little bit in the consumer debt levels and so forth. And once again, we've talked about this before, where there's definitely a transition going on inside the economy. And, that's definitely put the Fed in a tough spot. But, once again, overall, things are halfway decent,
Yeah.
and they're actually pretty good.
Yeah. I mean, the biggest concerns for me, obviously, we need to get a handle on the employment situation. We'll get the first significant read on inflation tomorrow. When we have not gotten an inflation read since September. That was the September Producer Price Index. And tomorrow, December 5th, we'll get our first read on the Personal Consumption Expenditure Index. That is the Fed's leading gauge on inflation. So that will obviously be important as they go into their meetings on the 9th and 10th. Last thing, some themes in 2026 that are a little bit concerning. This is from Yahoo Finance. 3 themes to pay attention to. Delinquencies of commercial-backed securities hit an all-time high of 11.76% in October 2025. We've talked about the $1 trillion of debt in the commercial real estate space that will be coming due. That is something to keep an eye on. Auto loan delinquencies, not some we talk about, but auto loan delinquencies are climbing at an alarming pace. According to the latest update from Fitch Ratings, the auto loan delinquency 60-plus delinquency index, which is a common subprime measure of auto loans, payments are now delinquent over 60 days at an all-time high of 6.6% in October. Subprime auto loan delinquencies during the Great Recession topped out at around 5%, and the peak was at 6% in 1996. So we're seeing auto delinquencies at a historic high.
Which kind of illustrates how the lower end consumer
is struggling.
Definitely pressured right now. Will reducing rates help that very much? I would argue not really, because Fed funds rate is the shortest term, so it doesn't do much on longer term loans. So there are some, concerns and stress out there, that's for sure.
In the last piece, and again, this really does unfortunately fall to lower earning consumers, is credit card debt. Based on data provided by the Federal Reserve Bank of New York, the share of U.S. credit card balances in arrears on their payments by at least 90 days rose to 12.41% in the third quarter of 2025. U.S. consumers are now holding $1.2 trillion of credit card debt. So we are certainly seeing that this debt situation, whether it's government debt, whether it's personal debt, I mean, this really could be one of these major issues that we keep talking about, doesn't seem to get addressed, but eventually you got to pay your bills.
Right. And it's something the Fed tries to address, but they truly can't address it. That really has to be done through fiscal actions, through spending, taxing. That's that's really coming to a head. And we've had this issue before, and
Yep.
it will be something we forever deal with.
Forever deal with. We
We'll see
love
how
to
we get.
spend as Americans,
Yes, we'll
but
see how we get through it.
what we're seeing is the economy's strong, labor market is softening. It does seem like inflation is under control. These debt situations we got to keep an eye on, but barring anything major unforeseen, I don't see a lot that is really going to hurt the outlook of the market in the near term.
Right. And, once again, we've had volatility over the last, really October turned out to be a pretty decent month where there's always a lot of volatility in October. It turned out to be a positive month. November, a lot flatter of a month. So we saw a lot of volatility. We had a nice up day on the last day of the month, and that helped take a nice up day on the last day, took the S&P for the month up 0.13. The Dow pushed up for the month 0.32. The Nasdaq though for the month was down 1.51. So, really what that illustrates is, yeah, it seems like a calm month. It definitely was not a calm month. We had, a 5% pullback. I think at one point the Nasdaq was down close to 8 or 9% off its highs. So we've seen a little bit of a rotation once again coming out of the tech stocks, AI stocks, more speculative stocks into your more defensive, portfolios, your more defensive stocks. Will that hold, or is that just another correction like we saw earlier in the year? Hard, that I wish I knew the exact answer, but we need to make sure we have good stability in the portfolios. You'll see that when we talk about how the different portfolios did, but we also need to have some exposure to those growth areas too.
Absolutely.
So that's kind of where we're at right now. Year to date, we take the S&P through the end of the month was up 16.45. So even with a pullback, we're pretty good run for the year in the S&P. The Dow Jones up 12.16, and the Nasdaq, even though it had a rough month, was still up 21%. So you still see a big difference between your high growth technology, more speculative stocks versus your more defensive stocks in the Dow. That dichotomy, stays with us. On the international markets, the EAFE up 24.26% for the year. Emerging markets up 27.11% for the year, and the U.S. aggregate bond index actually up 7.46, and that's because we've seen the longer term rates come from 4.2, 4.1 down to 4%. We actually dip below 4, temporarily for a day or so, and I've talked about this before, that 10-year I think is going to stay in the low fours, 4.5 is kind of where we're range bound, I think, for a long time.
But I think what's important when we talked about the bond index, what people have to remember is that's not necessarily the cash yield that bonds are paying. That's appreciation because interest rates are coming down, which means prices of bonds are going up.
Absolutely. Absolutely. Yields, you can only, short-term money, 3.5% at best. Go a little longer out, you can get into fours, maybe fives, depending on credit. We're trying to stay short with what we're buying. From a portfolio standpoint, as I mentioned before, defensive worked really well in November. Our dividend yield portfolio up 5.5% for November. Year to date, it was, actually slightly negative going in November. Year to date, we're now up 4.5%. Gainers, Old Republic up 17%, Medtronic up 16%, J&J up 10%. This one thing you'll see is healthcare starting to work. Tech, not so much as we go through these numbers. Laggards in November, Chevron down 4%, Public Storage down 1.4%. A little bit of pullback in energy. Oil prices are getting pretty low, so you're going to see some pressure on the oil companies. Year to date, J&J's our big leader, up 43%. American Electric Power up 34%. Amgen up 32%. Laggards, Packaging Corp down 9.4%. Public Storage down 8%. Our growth with income portfolio, more of our balanced portfolio, for the month was up 0.3%. Year to date, we're up 17% in there. Big gainers in November, once again, J&J up 10%, Berkshire Hathaway up 8%, Lennar up 6%, Nucor up 6%. Laggards, here we go, NVIDIA Tech down 13%, Microchip Technologies down 14%, Disney down 7%, Big gainers year to date. Gold, our gold position up 60% for the year. Raytheon's up 52%. Nucor up 37%. Nvidia, even though we gave back 13%, still up 32% for the year. Year-to-date laggards, Nike down 14.6%. EOG Resources down 12%. Digital Realty down 10%. Price potential portfolio, a more aggressive portfolio. Year to date, well, up 39%, but we gave back 2% last month. Once again, gainer wise, Angler Gold up 26%, Expedia up 16%, Google up 14% for the month. Laggards during the month, Dell down 18%, AMD down 15%, Mercado Libre down 11%. Year to date, Celestica is still our big winner, which we bought in April, up 367%. AMD up 80%. Google up 64%. Our big laggard that we still in the portfolio, Hallmark, down 28%. Our appreciation with income portfolio actually gained 1.6 for the month, so a good month there. Year to date up 22%. Once again, gainers, Eli Lilly up 25, Amgen up 16, Broadcom up 9. And laggards, Eaton down 9%, Microsoft down 5%, Booz Allen down 4.25. Year to date, Lam Research, big winner in there, up 116. Amphenol up 103, Broadcom up 74, CVS up 79. Still in the portfolio, our losers, Energy Transfer down 15, EOG down 12. Small cap portfolio. So our most volatile, November, we were basically flat. Year to date, we're still lagging in there. The actual small cap index is up, but what's kind of driven that index has been a preponderance of companies that don't make any money.
The same
It's
story.
very speculative.
Same story.
We're definitely a lot more quality oriented, value oriented in our small cap portfolio. But in November, we had some decent gainers. Collegium Pharma up 30%. Arcutis Biotherapeutics up 22%. Assembly Bioscience is up 22%. Unite Fire Group, it's an insurance company, up 21%. Obviously, a little bit of biotech health driving that portfolio last month. Laggards, i3 Verticals down 23%. OneSpan World Holdings down 12%. TAT Technologies down 8.5%. So once again, healthcare did good. Tech did poorly. Obviously illustrated in small caps, which are which have a lot of movement to them. Year to date, Ligand Pharmaceuticals up 90%, Alico up 34%. We kind of weeded out a lot of our losers in there, so nothing really sitting in the portfolio with anything substantial to the downside.
And I think what's important for everyone to realize when it comes to our small and mid cap portfolio, these are smaller companies. They're underrepresented in the major indices. They tend to be international and they tend to be volatile. So that is a portfolio where there is a lot of turnover. That is a portfolio that can generate significant gains with the turnover. So that's often a portfolio that we hold in retirement accounts where you have longer outlook to deal with the volatility and where the tax implications, really don't play into our investment decisions.
Yeah, you get good years and bad years. Last year, we're up 30+% in there.
Yeah.
This year, not so much, but we got a couple of weeks left. Who knows what's going to happen in there? Expectation wise, I think, we're kind of in this bout of volatility, got a lot of rotation going on. Historically, you tend to see a little push higher towards the end of the year. I'm still in that camp. I think we have yet to see the highs of the month, maybe even the year. But it could be a bumpy ride. Not a lot of trading days left in the year. But, the outlook for next year is, I would say, fairly decent, but we want to be selective in what we're holding, and it could be a year of different leadership is my thought process.
Yeah. I was going to say cautiously optimistic, to use a phrase that everybody uses.
That everybody uses.
Everybody
It
uses.
is what
So
it is.
happy holidays from all of us at Ellsworth Advisors. We hope you have a great December. We will talk to you in 2026. If you need anything, please do not hesitate to reach out to us. Have a great holiday season from all of us to all of you. Thank you.